steel major Tata Steel reported a lackluster set of earnings for Q1. A 92% drop came in for profits. And what has led to this tepid performance? My colleague Ashesha is here to decode this earnings for you. Ashesha?
Well, yes, largely in-line set of numbers from Tata Steel this time. European operations continue to be a pain point. European EBITDA per ton has come in at a loss of negative $96 per ton versus negative $95 per ton that the company had reported in the previous quarter. Lower volumes, global macroeconomic concerns is why Europe continues to be a concern for the last several quarters. India operations meanwhile stood out. Volumes were on the lower side, but net realizations were on the higher side, and hence EBITDA per ton declined by a marginal 2.5% on a quarter-on-quarter basis. Meanwhile, company incurred a capex because of which net debt has risen from nearly 67,500 crores to about 71,500 crores, and that is a bit of a concern. In fact, we have a couple of brokerage notes that have come in. First up, let's talk about CLSA, which has maintained its outperform stance on the stock with a target price of 125. They say results were largely in line. Adjusted EBITDA was driven by income from long-term lease agreements with Tata BlueScope. Morgan Stanley, meanwhile, has maintained its equal weight stance on the stock with a target price of 110. They say standalone EBITDA was slightly ahead of estimates on account of better realizations that the company enjoyed in the quarter gone by. European operations could remain overhang in the near term. All in all, numbers were in line. Net debt has risen, which could be a concern. Brokerages are concerned about European operations and the fate of UK business, which depends upon the support that the company will receive from the UK government.